Welcome to our second broadcast of the Coal Scene. I'm Chris Hamilton, Senior Vice President of the West Virginia Coal Association, and I'll be your host for the following half hour. Joining me today is Mark Muco of the West Virginia Department of Revenue. In today's show, we'll be taking a look at the economic impact of the coal industry. We'll also be discussing the industry, how it's taxed, the role these taxes play in filling state budgets and meeting the needs of the average West Virginian. For those of you who may be tuning in for the first time, I'd like to start our show by simply saying a little bit about the Coal Association. The West Virginia Coal Association is a trade association formed in 1915. It represents the state's coal mining industry. Our primary responsibility is to promote the industry and serve as its communications link with the public and government. Our membership includes a number of well-established coal-producing companies, as well as small and medium-sized companies who serve the industry around the state as well. Most of those small companies provide the support that keeps the industry running. In total, we represent more than 200 member companies. We represent about 80% of the state's coal production that's mined here. And as I said, joining me today is Mark Muco of the West Virginia Department of Revenue. Mark, let's start out by how about just responding to how important the coal industry is to the state's budgetary process from your perspective, being the collector of those tax receipts.
Well, the coal industry is very important for the state economically. The industry latest report has over 30,000 direct jobs, probably in excess of 50,000 jobs when you consider coal-related employment as well as direct coal employment. You have wage payments in excess of $1.5 billion a year. This year, the total output of coal in West Virginia will bring in excess of $10 billion in gross receipts. And the industry directly represents over 7% of the state's gross state product. You throw in the direct and indirect, it comes out to around 10%. It's a very important part of the segment of the economy. And the state of West Virginia historically has imposed its tax system in and around the coal industry, just as other significant severance type states like Alaska and New Mexico and Kentucky do. And so there are significant taxes imposed upon the industry, and those taxes support various functions of state government, and therefore very significant given the different types that are imposed.
If we were to assign a percentage of the amount of total revenues, and you touched upon a lot of areas, from income tax, and there's the unmined mineral tax that's levied on the county basis, and payroll dollars, severance. If you add it all up and had to assign a percentage of the total state's of the state budget that's attributable to the coal and its associate members, what would that number be?
Well, in terms of severance tax alone, it accounts for roughly 10% of state general revenue spending is severance taxes on coal. If you add in the various other taxes that are imposed at the state level, that moves up probably to between 15 and 20%. Add in electric power generation type taxes, you move up another 5% to around 25%. And then we have the local taxes, property taxes that are imposed. You mentioned the unmined minerals tax. The unmined minerals tax is actually one of the smaller yielding taxes because you're taxing a value that's relatively heavily discounted, because we're not sure when the coal will be produced, whether it'll be produced 5 years from now or 50 years from now. So it's a greatly discounted value. But overall, the property taxes on coal well in excess of $60 million a year. Benefits particularly those counties that have significant presence with regard to the coal industry. One of the benefactors, Boone County. And Boone County has some of the highest paid teachers in the state, and that has to do a lot with the coal industry's presence in Boone County.
You mentioned Boone County. Boone County is the leading coal-producing county within the state's boundaries. And I believe last year Boone County's production total equated to about 20% of the total state's productivity.
Right, Boone County has a big share of the total activity in the state. Basically our largest coal-producing county for I don't know how many years, but a long time.
We're talking total tax and percentage of total taxation within the state. I know, and you mentioned the electric utility business. If I'm not mistaken, when you add the direct taxes against coal with the taxes that are placed on electric generation from coal, if I'm not mistaken, the sum total of those two taxes is somewhere around 60 or 65% of all business taxes paid to the state.
I haven't done that calculation in some time, but it is a lion's share of total direct taxes imposed upon businesses in the state of West Virginia. Those two industries, definitely more than half.
I've seen that a lot in some of the coal-related journals and publications, and seems to me because of the high energy market and the pricing levels that we're in today, that may even have increased from where it was benchmarked a couple years ago. At least stands to reason that
it would probably have increased. Last fiscal year, coal industry produced roughly $300 million in severance tax for combination of state general revenue and local governments. This year, it's likely, when the year is over, to be closer to about $430 to $440 million. So that's a huge increase, about 130 million or so compared to last year in one single fiscal year.
Wow, that's truly a substantial number. And I guess when you add that overage over from 1 year going backwards, I guess over the past 5 years, it seems to me that that would be up at near $500 million, perhaps.
The amount of severance taxes coming from coal more than doubled in the last 5 years. So
again,
increase.
Strong market, higher pricing primarily.
Primarily higher pricing, a little bit of additional production as well. Production a few years ago was in the 145 million ton per year range. We're now in the neighborhood of 160 million tons at the current peak. So a little bit of production increase.
A little bit of both. A whole lot on the side of
a whole lot on the pricing side.
Yes. No question about it. We've seen that. Could you analyze the severance tax program to the extent of how, at what percent, how that tax is levied? There's a portion I know that's returned to counties, and presumably that portion has increased commensurate with the overall increases in state coffers.
Right.
But could you explain just a little bit how that program works?
Talk about the general severance tax is 5% of business gross receipts attributable to coal production. And there's a little bit of processing of coal also in the base, but for the most part it's coal production and the sale of coal. And that 5% tax rate is made up of two components. There's a state tax rate of 4.65% and a local tax rate of 0.35%. Those combined two taxes, or the 0.35 and the 4.65, are projected to bring in somewhere around $430 to $440 million this current fiscal year. Part of that will go to the infrastructure bond fund, about $21 million out of a total of $24 million. The rest largely comes from natural gas. Majority of it will end up in the state general revenue fund. There also will be the 0.35% will go back to local governments. It's split in two components. 75% of the tax proceeds on the local tax, it goes to the counties where the coal is actually produced based on their relative share of coal production. And the remaining 25% is distributed across the board to all counties and all municipalities on their basis of total population compared to the state total. not more than about 4 or 5 years ago. The total local coal severance tax was consistently around $16 million a year. This year, it should be in the neighborhood of $38 million, possibly as high as $40 million. So it is more than double. Just with, like, the price of coal's gone up, so has the excuse me, the amount of local tax distribution. Also, there's a little provision in the code that for a 3-year period between fiscal year '07 and fiscal year '09, 50% of any excess coal severance tax collections, that would be state collections, over and above the base year 2006 will go over to the Workers' Compensation Debt Program. And we're expecting that this fiscal year up to about $80 million may be transferred over to the Workers' Comp Debt Fund as a result of enhanced coal severance tax collections compared to fiscal year 2006.
And that's all overage. That's all over and above what we estimated and collected last year.
That would be over and above what was collected in '06.
Okay.
50% of over and above what was collected in '06. That means compared to the '06 collections, we're looking at more than a $160 million increase total.
I'd like to come back and talk about the workers' comp debt and the significance of the increase severance on coal a couple years ago, or the special tax that was dedicated to retire that debt. But you mentioned something that I'd like to for us to explore a little bit. I'm not sure everybody realizes that all 55 counties receive cash payments from the coal severance program. I think there's a common thought amongst a lot of people that just the coal producing counties gain. And I know we have 25, 26 actual coal producing counties, and that number varies from one year to another, couple. And 7 or 8 of those 25 or 26 probably account for 75% of total production. But yet all 55 counties receive severance returns.
That's correct.
To fund, in some instances, I know a large portion of the county and municipal government.
That's correct. It's all based on population. So if counties like Berkeley County, which has a fairly high level of population, will receive a
But
share.
no mining.
No mining activity in Berkeley County. They still receive a quarterly coal severance distribution based upon the county's population. And the county share in that case is based on the unincorporated population of Berkeley County compared to statewide population. The city of Martinsburg would also receive a distribution based on its share of population. And in fact, both the city of Charleston and the city of Huntington receive a significant amount of coal severance funds on a quarterly basis because of their relative populations.
You understand Charleston because there's a huge mining component here in Kanawha County. Very little in the Huntington area.
Cabell County is a non-producing county, but the Cabell County and Huntington still receive a pretty good share of coal severance tax revenues because they have a relatively high population.
And when you think of, but there's a lot of coal to ship through Huntington. They at least have some understanding of the industry. But when you think of places like Wood County, Doddridge, up in north central, and also the entire eastern panhandle. You mentioned Berkeley, but there's also Mineral and Jefferson, and it's interesting that they receive again dollars to fund their local government from coal mined right here in southern West Virginia.
Right. Not only directly through local coal severance tax, but also some of the infrastructure projects that are funded or located in the Eastern Panhandle that are funded by the Infrastructure Bond Fund, and those monies come from severance taxes as well.
I remember seeing, let's talk about that just briefly because, again, to the extent that people know about the coal severance program, they know that dollars are returned to support local programs. But there was this infrastructure component that's relatively new, 10, 12 years old maybe now, maybe a little.
It's probably at least well over 10 years old,
Okay.
probably, I'm going to say closer to 15 now.
Closer to 15.
And it's a $300 million bond issue that the state is being backed by $24 million of annual proceeds from severance taxes. It's a revolving fund. I think up to 20% can be used for economic development projects, and the other 80% are mainly water and sewer type projects, infrastructure projects.
I don't recall the actual percentage, but it seems to me a large percentage of those dollars also went to the Eastern Panhandle because of the growth and expansion that the Panhandle was experiencing.
I can't speak to the actual dollars used, but it's based upon where there's needs for infrastructure, and since the Eastern Panhandle is a growth area of the state, their infrastructure needs are fairly high, and I'm sure they've had some projects funded through the Infrastructure Bond Fund.
Let me ask, does the tax department or revenue department today, does it receive expenditure schedules, or does it have any idea how the severance is expended at the county level?
Actually, the tax department at one time used to oversee county budgets. That particular function has been transferred over to the state auditor's office. And the state auditor's office will monitor local government budgets, and that information is actually available on the state auditor's webpage. The annual budgets have to be submitted by the various local governments, and there'll be a line item in there for severance taxes. So they're the ones that kind of oversee the expenditure of the fund, and the severance tax is a separate fund. The coal severance tax, that is a separate fund from the general fund for local governments.
Okay, I know. Just looking at some of those budgets over the years, they seem to support a lot of programs for seniors, the less fortunate, and just some needed government services as well within those areas.
Definitely, the Kanawha County has a certain restriction on its use of coal severance that's a little different than the rest of the state, in that there's provisions in the code that the money must be spent in the areas of Kanawha County where the mining actually takes place.
I think I'm getting cued to take a break here, so why don't we, this is probably a pretty good place to stop for a few moments, and we'll come back and we'll talk more about coal's impact on the budget and the coal severance program.
Thank you.
This is Jack Thomas. Today, someone almost brought Jack something to eat. Someone almost drove him to a shelter. And someone else almost brought him a warm blanket. And Jack Thomas? Well, he almost made it through the night.
Once again, I'm Chris Hamilton, host of the Coal Seam, and with me is my guest, Mark Muco of the West Virginia Department of Revenue. We've been discussing the role of coal mining in the state's economy and how the coal severance tax program works and returns money to all 55 counties. Mark, let's talk just a little bit about the current financial crisis that we find ourselves in, and how and it's truly a national, maybe even a worldwide crisis, downturn in the economy. I read recently where West Virginia is one of just a handful of states that has ended the fiscal year with a budget surplus. And that has to be attributable in part, at least, or perhaps in large measure, to a strong energy market and the pricing levels that we're experiencing within the coal industry.
We've definitely had very firm pricing levels. In fact, the current budget year forecast, which was prepared in excess of a year ago, was prepared at a time when the spot price of coal was in the $45 to $50 per ton range. Since that forecast was developed, the spot price of coal jumped from that $50 range to a peak in July of around $145 a ton. Since then, we've seen some collapse in coal prices along with oil prices, but not quite as bad as oil prices. We're still in the range of around $80 a ton on the spot market for coal, so we're still way above where we were over a year ago. And as a result, the average price of coal, as reflected on the tax return, went from around $50 per ton last calendar year, to probably a little in excess of $70 per ton this calendar year. And as a result, we had a huge influx of revenue, and that's helped provide growth in our tax base, also growth in the economy, because coal mining employment is up somewhere in the neighborhood of 8 to 10% this year compared to last year. If it weren't for coal mining employment, our overall employment picture in 2008 might have been slightly negative, but ultimately will be slightly positive. So it's had good impact on the state in terms of employment, in terms of wages paid, in terms of tax revenues attributable to the industry, and that's propelled us into a positive situation revenue-wise, whereas our neighboring states are actually facing budget shortfalls at the present time.
And shortfalls by big numbers. I was amazed. I attended a conference here just right after the first of the year, where there was a lot of neighboring coal-producing states, in fact, at the conference, and you know, people were observing that we finished the year with a surplus in our budget. And the state of Virginia, for instance, and I don't know if you have the opportunity to look at some of these other states, and you know, for comparison purposes, but state of Virginia, if I'm not mistaken, is like a $4 billion budget deficit, and Kentucky a couple $1 billion, and I was astonished to hear how high some of those deficits really were.
Well, I think the numbers are deteriorating around the country from where they were just a few months ago, but and the Virginia number, when we're talking about $4 billion, that's spread out over a period of probably about 3 years or so.
Okay.
But we're running in neighboring states. They're running short on compared to their budgets, somewhere in the neighborhood of about 5, 6, 7%, which is very significant, particularly since most monies are spent for items such as education and Medicaid, which are very hard to cut. And if you remove those big items from the budget, and you have a 5 to 7% shortfall for the rest of government, you're talking closer to maybe a 20% reduction needed in the budget to be able to fill in that type of gap. So as a result of that severe strain, a couple of our neighboring states are actually looking at some tax increases at the present time to fill in their gaps. Particularly Maryland had some tax increases a little over a year ago, and Kentucky is now looking very strongly at cigarette tax increases.
I'm not sure what other industries are doing as well as your energy industries today. You know, if you have a diversified economy, I'm not sure what other industries in this whole economic downturn that you would rely upon. So it seems like increasing taxes or imposing a new tax would obviously be a quick fix, but it may be one of the only few alternatives that a state really has.
Some states are into that mode. I think most states are going to try to get by trimming their budgets, but there'll be probably a handful of states that will have to raise taxes in some shape or form. The energy sector is not completely immune, because we have a global recession going on, and even in the coal industry, last few months there have been some layoff announcements, mainly in the metallurgical sector, because folks around the country are not making steel, and therefore there's no orders for metallurgical coal, regardless of how high the price is. If there's no buyers, it creates a problem. So we're also mindful that we'll see some. Energy's done very well for West Virginia, but I think energy's also going to suffer a little bit over the next couple of years, unless the economy pulls out of its doldrums.
It's a good point. How do you see that? How do you see that working? Does the surplus today? I mean, it just seems like we have to be extremely stingy and prudent on how we expend that, because we have a little cushion here. But as you point out, prices are dropping in certain areas of the energy sector, coal being a primarily one. I mean, they're falling, and may very well be, at least as it relates to some unique spot prices. The pricing may be cut in half over a 12-month, 18-month period from what it was 9 months ago to what it may very well be, this time next year. And so with that will come some decreases across the board in terms of the revenues generated from the industry.
Right now, our forecast is a little bit of a fallback in price from around the $70 per ton level to somewhere in the $63 to $65 per ton level, which is still fairly high by historic standards. So we're building in a reduction in price. Of course, the forecast was developed probably a little bit more than a month ago, and that can change depending upon how conditions fare. Prices, we hope, are a little bit sticky in the downward direction, in that some companies are fortunate enough to negotiate 2 or 3 year contracts at a certain price, and that helps to kind of stabilize the overall price environment for coal. In that you have a mixture of long-term contracts along with spot purchases. But the state has, over the last few years, been pretty fiscally conservative in terms of utilizing those extra revenues that have come by way of significantly higher energy prices and significantly higher income taxes related to the industry. A significant part of the surplus has been devoted towards one-time debt payments, such as the Teachers Retirement Fund, and also there's code language in place that allows us to pay down the workers' compensation debt a little bit quicker as well. So some of the surplus monies have been used for those purposes, and that set West Virginia up in a little bit more favorable position as we return to. Well, actually, we end up with revenue growth that's probably going to, in the next year or two, be a little less than historical averages.
You mentioned met. You mentioned met prices are probably falling, and you mentioned some of the market difficulties that they're facing, and that's an excellent point, because I'm acutely aware of a number of companies that deal within the export met market, and there's a lot of concern there right now. There's been some curtailment in those operations already. A couple announced layoffs, and you know, knowing their operations, they're in some real tough geology and some difficult mining conditions that present additional challenges as well. So I mean, kudos to those guys, but they are playing within an international market, and when the economy turns downward, and buildings aren't being built and the infrastructure is not going in, it's the met market that seems to be the first that's